Good evening. Even as a new look North Block is in overdrive with the spate of reforms either already passed, in the process or on the anvil, the reform train, it seems, has failed to impress rating agencies around the world, with Standard & Poor's warning of yet another downgrade in the near future. According to the S&P's report on Asia Pacific released yesterday, India still faces a 1 in 3 chance of a ratings downgrade in the next 2 years. India's rating is currently BBB-, just a notch above the junk grade status, not to mention the lowest of any BRICS countries. The report adds that if the country's economic growth prospects dim, its external position deteriorates, its political climate worsens or fiscal reforms become slow, the chances of a rating downgrade will increase. The report, however, does admit that a flurry of reforms, including the diesel rate hike, cutting energy subsidies and opening up the aviation and retail sectors to FDI, has slightly revised S&P's view on downgrading India's rating. Ladies and gentlemen, tonight on The Big Picture, we ask the question, how far should we trust rating agencies and their reports? If the threat of a sovereign credit downgrade reignited the reform agenda in the first place, is this then a second wave of international pressure aimed at milking more reform-oriented steps out of an embattled government? We'll also try and find out whether the finance minister's optimism is well placed. Remember, P. Chidambaram has come out and said that we should shed all and any self-doubt and remains confident that the investment climate as well as the growth is on its way back to required level. On the show tonight, Dr. Santosh Mehrotra, DG, IAMR, International Institute of Applied Manpower Research, Jagannadham, Thunuguntla Equity Head, SMC Capital, also Mohan Guruswami, Distinguished Fellow at the Observer Research Foundation, and completing the panel will be Rajesh, Mahapatra, Deputy Executive Editor of the Hindustan Times. Welcome to the show, gentlemen. I'd like to start with Dr. Mehrotra, if I could. Dr. Mehrotra, while S&P has acknowledged that the government seems to have reignited reform efforts, the report and its authors claim that the introduction of FDI in many sectors does not immediately address the fiscal deficit concern. The report also adds, I might add, that while a diesel price hike and a cap on subsidized LPG cylinders will help, no significant steps have been taken by the government to ensure that the country moves on a path towards fiscal consolidation. I'm pretty sure that policymakers in India will wholeheartedly disagree with that view. What do you say?
Of course we disagree with the view. In any case, the S&P itself has said very clearly that we have taken no new position in this announcement. All we've done is repeated an announcement which we had made in June or July. So if anything, we know that between June, July and now, there have been significant movement by the government on the fisc, on reforms generally. So, I mean, this is completely unacceptable and not understandable. So, in any case, I don't think we need to worry very much about it.
Right. Fair and short, concise reply there, Dr. Mehrotra. I'd like to put the same question to the gentleman on my left right now. Mohan Guruswami, do you agree with Dr. Mehrotra that this is, first of all, we should not be really concerned what S&P thinks or any other rating agency thinks? Also, do you agree with them as they say nothing has been done on the ground?
I agree with Dr. Mehrotra. You know, the rating agencies have a dubious record of how they confer ratings. Before Enron collapsed, till 4 days before, it enjoyed top rating. When Fannie Mae collapsed, Moody's gave it a top rating. And if you look at most of the countries in Western Europe, and even the United States, their overall fiscal situation in terms of ratios is worse than ours. You know, they would not dare downgrade a France or a Spain they did it with the United States, and the head of these S&P ratings 2 months later got fired. So, you know, I think the record, and governments will act in our national interest, not to be pushed around by rating agencies. And after all, this is the 3rd largest economy in the world now, in PPP terms.
Right.
We've just gone past
and it's Asia's 3rd largest economy.
Asia's 2nd largest.
Second largest now.
Okay.
Right.
So you're not going to get pushed around by these guys.
Right, right.
And there's also enough record that they often act in collusion with merchant bankers. Merchant bankers are looking for, easy ingress and exit in terms of FII
Right.
And that market has been very good for those guys. They make lots of profits.
Let me go to Jagan for a bit now. Do you agree that the record is in itself dubious? Everyone agrees there. Also, do you think that, would you say, because S&P says it expects the government fiscal deficit to be higher than the government's budgeted estimate, which is 6% of GDP for the financial year ending March. Deficit outlook, according to S&P right now, governed by lower than expected tax receipts, also higher than budgeted subsidies, also weaker growth. First question to you, dubious record, do you agree? Also, would you say that because they've said fisc will touch 6%, do you think it'll go that high?
I think they don't have a great track record for sure, both in calling the positive side as well as negative side. And one more thing is today's market reaction itself has shown market's view about the S&P's downgrade. I mean, the market has immediately bounced back because the market has way of reacting to the things. And then I think to the extent of what the government can do, they have done. They have put their own government at risk in the process, and I don't think they can expect more than this. On top of that, as far as implementation is concerned, these are things which will take implementation, like 6 months. How can they expect, because the original rating came in June, July, and it's just a matter of 2 months. How can they expect that reform should be taken as well as implemented within a matter of 2-3 months? That won't happen any which way. I think yesterday he was while he was speaking, the S&P, the spokesperson himself is in a double mind. He is unable to take a stand whether what is he talking about. All in all, I think market is not taking it very seriously, and if the government can able to implement the already taken decisions, and if it can take the new decisions, I think S&P.
You have a point. The S&P rep came on television and he said, "Oh, this is not a downgrade. We're just looking at future prospects and whatnot." We'll talk about the markets in a bit. I want to come back to you for the markets and how they were rattled for a bit yesterday. But I want to go to Rajesh Mahapatra right now, who's been listening very patiently. Rajesh, I have a question for you. The report itself is titled "Asia Pacific Sovereigns: A Bit of Stability in the Sea of Uncertainty." Is that an apt title, or going further, a correct assessment really of the situation? Even the same rating agency, remember, S&P downgraded India from stable to negative in April.
I'm worried about the prospects of certainty as far as S&P is concerned. I really don't, I used to maintain that when the rating agencies give you upgrade you on the rating chart, the governments go to town saying that, our ratings have been upgraded. And therefore, when they downgrade, you really, why do you go and shrug it off? But, looking back now, I think if you look at what happened in June, and I'm increasingly coming to believe that, all of these acts were sort of calibrated to create a certain amount of pressure, and maybe that would have succeeded to some extent. And I think now they are getting a little more greedy. And what is a downgrade now? We are waiting for. If another downgrade comes, India's sovereign rating goes down to junk grade. I would say the first thing we should do is to junk this report. I think, we should stop worrying about what international rating agencies have to say as to what would be good or what would be bad for India. I think as a country we have a repository of enough well-endowed, experienced people, leaders, and the usual wisdom to figure out what is going to be good for our country and what is going to be bad for our country.
Absolutely.
And there are patches, there will be bad patches that we will go through, but I don't think we should be dictated by what agencies outside or people who draft these reports after a 48-hour trip to New Delhi, Bombay. I think we should stop taking them seriously. Today, what India needs, or rather the government needs, is a concerted effort to look at what is it that is holding back India, what is it that is not translating our growth gains into inclusiveness. And that's something that we need to focus on, rather than worry about whether an agency is going to give us a poorer rating or an upgrade.
Right, Rajesh, point
that's
taken.
what I would say.
Point taken. Dr. Mehrotra, I want to come to you and elaborate on the point that Rajesh Mahapatra just made. There's a government panel that has been looking, the Kelkar panel, your friend Dr. Kelkar, into ways of improving government finance. And if I could quote him right now, he said the economy is on the edge of a fiscal precipice. He has suggested slashing subsidies urgently to curb the deficit. There seems to be sort of a bubble, a pressure bubble building, Dr. Mehrotra, both from inside and the outside, meaning domestic murmurings as well as international, well, let's just call it friendly advice, international friendly advice. Could this be perceived as angling for increased reform steps, the second wave of reform, as some would call it?
I would tend to go along with that reading of the situation. I think the Kelkar Committee report is a good follow-up to the 13th Finance Commission recommendations. And there is no question about it that the government needs to do much more than it has done in the most recent weeks on reducing expenditures and mobilizing more revenues. Because in an environment where growth has slowed, it is not surprising that revenue inflow has tended to sort of stabilize and tended to some extent fall. So there's no question that if we are going to, as Rajesh rightly put it, if we're going to make our growth more inclusive, one of the ways to do it is to mobilize more taxes and cut unproductive expenditures. And many of our subsidies, because they are so untargeted, I mean, the fertilizer subsidy is very poorly targeted. The kerosene subsidy, as you know, is going into massive levels of adulteration of high-speed diesel. And there are massive reforms needed in the food subsidy as well, and massive reforms are on their way with respect to PDS, according to the Nandan Nilekani Committee's reports. So in each of these three areas, whether it's fuel, fertilizer or food, there are a series of reforms which are not only needed, but the government has already put out its intention of cutting expenditures by rationalizing these subsidies and also making the delivery mechanism much more effective. So, I mean, if the government does move ahead, as I'm reasonably hopeful it will, in regard to these three subsidies, in accordance with what has been recommended by the Nandan Nilekani chaired committee, then the possibility of realizing cuts in subsidies and therefore reductions in fiscal deficit are going to happen, and so the biggest concern still remains, and whether it's the international agencies like the IMF or the rating agencies, the biggest concern remains about the ability of the government to reduce fiscal deficit.
Absolutely, absolutely. Dr. Mehrotra,
the second big risk that continues is that about the political stability.
Absolutely. A very important point that you raised, which one I want to talk about with my guests in the studio. But first we'll take a small break. We'll come back and we'll chat with Mohan Guruswami and Jagannadham Thunuguntla about what Dr. Mehrotra just raised, the political uncertainty as well as the language and tone of the S&P report. That's after the break. Don't go anywhere. Lots more to come on The Big Picture. Welcome back to The Big Picture. Mohan Guruswami, I want to ask you this. It seems from the language and the tone of the report, or the S&P report, this particular report, it's stressing on the fact that there is uncertainty, political and otherwise, which is, to a certain extent, let's just admit it, it's true. There is political uncertainty there as well. The reforms announced so far have helped investor sentiment more than the situation on the ground. This is what most economists would say. The problems at the ground are still unaddressed. And the view is the economy cannot get back on track till sustainable growth is achieved and problems on the ground are solved. Would you agree with that? Problems on the ground still exist?
I do not share this obsession with the stock market index. Okay, the stock market could be doing well and the economy could be doing badly, and as has happened before.
Yeah.
So I think this focus entirely, the entire financial sector on the stock market as the bellwether of the state of the economy is wrong, misplaced. And the finance ministry, the smartest thing it can do is to junk all those TV monitors there.
It is quite misleading.
It is totally misleading. The reform process we again focused on FDI. I think that if there's more FDI, we're reforming. Not necessarily true. I think there are lots of things to be done domestically. For instance, decontrol of the financial institutions. They're all under state control today. 90% of the finances are dispersed. That's another kind of industrial licensing policy. And now we see that 80% of the credit has been advanced to 10 or 12 companies. Then we also see that there's a pileup of 60, 70,000 crores every year as NPAs. And I think as long as the state is in control of these institutions, you will have this favoritism, this crony capitalism, and this NPAs are a subsidy. Because you're not going to get it back, and every year they're adding on. I think this reform should come here. And that means more reform in deregulation, decontrol of, and then you take it to public sector undertakings and things like that. Foreign investment alone is not going to solve your problem. And most of foreign investment, the fact is that, more than half of it is Indian money, which is rolling back.
Circumvents around and
absolutely, it's round tripping. It's the same in China, it's the same here. So when Indians begin to have confidence in our own economy, we will get more. And we should focus on FDI, direct investment money which comes to set up new factories and things, not on the stock market money. I think there is time we have to consider a Tobin tax. Each time it comes in, you tax it a bit, each time it goes out,
Let's put this to Jagannadham. Junk this obsession with the stock markets, right?
Yeah, I mean, stock markets are a strange beast. I think one should know how they function. But having said that, in a game where 2 lakh crores of trading happens in a day, I think you can't take it lightly. It will have systemic implications. And moreover, the money that comes is about, already this year, we already got $16 billion. That will impact rupee. Because why we have to take stock market seriously is because it will have implications. That same rupee you are buying the oil, because oil imports is a huge major bill. What I'm trying to say is that stock market is part and parcel of the economy. So we have to see it in the context. It has a nature of being volatile and strange beast. That doesn't mean we should completely forgotten it.
I'm not saying that, I'm talking about an obsession, only with that.
No, I'm saying obsession is not needed, but that's very much integral part of the economy.
True. Let me put very, very quickly another question to you. Before I go to Rajesh Mahapatra, markets were rattled yesterday. First, the IMF report came in, then this particular S&P report came in. The Sensex dropped by 162 points. Currency and bond markets also kind of wilted under pressure. The rupee fell below the $53 mark against the dollar. It created some anxiety in investors, even as bankers and economists. They seem to be saying that, look, our finance minister says that shed all doubt and our economy is on the track to higher growth as well. Now, these S&P and other rating agencies are saying this is not going to happen. How seriously is industry and the markets taking this? Also, this is surely something the market doesn't want to hear right now.
One thing is the market has rallied a lot in the anticipation, and so some profit booking is just a matter of the time. I think these reports have just become the triggers, not necessarily the reasons. I think once that wave is completed, today again the market has bounced back. What it shows is that market is saying just come on. I mean, we don't take you seriously. I think that itself is a sufficient message to the S&P. And moreover, if the government takes reforms here and the rupee it comes below 50 rupees, and there is absolutely no reason why India should become the again the hard darling of the global money, because we have to remember the growth is not there anywhere, and we are acting very aggressively with the reforms. Perfect combination and cocktail of global liquidity and Indian reforms. Excellent cocktail for India to take advantage to reach its deserving position.
So you're saying we are poised to do well right now. I want to go to Rajesh Mahapatra right now. The finance minister Rajesh has categorically come out and said, he's mentioned that there is no fear in his Chidambaram-led North Block of a ratings downgrade. Shed all self-doubt, says Mr. Chidambaram. He's also telling industry to get fears of a downgrade out of their heads. Now industry is asking the question, who should we listen to? Our finance minister who's all gung-ho and all guns blazing, or should we listen to some rating agency who's not satisfied with the reforms he's taking?
Well, you don't expect the finance minister to say that we really need to get worried about a rating downgrade, do you? I mean, his job is to keep up a brave face. His job is to sustain a sense of optimism, and that's what leaders are meant to do. So he's doing that job. I think as far as the industry goes, they know where to take their cue from. So I don't think, I mean, if you are looking at the stock market, and trying to sort of represent stock market as what would be the view or the mindset among our businesses, I think that would be erroneous. I think, if Athar, if we were to look at the stock market's behavior and pick up cues from there and therein look at our policy making, I think that would be a disastrous recipe. As stock markets behave in a way they behave, there is sometimes logic to it, and most of the times there is no logic to it. So let that be, but what we have to come back, and I go back to what other panelists said, that foreign direct investment is not going to cure all your problems. It is only going to facilitate or may be sort of adding on a bit. Your core challenge remains, how do you revive domestic investment? How do you revive your domestic consumption? And that's where the focus on inclusiveness has to come back. If your domestic investment, if your Indian economy domestically remains resilient, whether there is an S&P downgrade or upgrade, foreign investors will continue to flock.
It won't matter then, exactly. Right. Rajesh, I'd like to ask Dr. Mehrotra's view on this. You heard what Rajesh just said, Dr. Mehrotra. Domestic growth is the key. Would you agree?
Of course, entirely. I mean, let's just remind ourselves that at the peak of our growth rate in the year 2007-8, we had an investment rate of 39% of GDP. We had a savings rate of 38% of GDP. So what's the difference between 39 and 38? 1% of GDP, which means that was what was coming as FDI. So in other words, the majority of our gross fixed domestic capital formation is based on domestic savings. Now, our savings rate may not be at the rate of 38%, which it was 4 or 5 years ago, but it's still around 31%. And our investment rate still remains about 32%, point one, which is the reason why Mr. Chidambaram is relatively upbeat. Point two, just remind ourselves that within the last few weeks, the Prime Minister has taken a few meetings where my boss, Dr. Monte Carlo Walia, has also been present, and they've actually brought together the big public sector enterprises which are sitting on very significant funds, and all projects which involve investments of over 1,000 crores are being fast-tracked. That was the purpose of that meeting, and that needs to happen now quickly. And as public investment increases, it will pull in private investment. That's the way the economy functions.
Right.
So public investment will increase, private investment will be pulled in, and at the same time, if on the fiscal side, as I was saying to you earlier, reforms continue, subsidies are pulled back,
right,
the fisc improves, that creates the space for the RBI to reduce interest rates.
Absolutely.
So
that is
going
the game
to be
plan.
the sequence. We are already begun to see the beginnings of that sequence.
Right, that is the game plan, sir. I want to come to Mohan Guruswami for his last comments. Sir, insurance and pension sector reform, so-called second wave of reform that Mr. Chidambaram is really working hard on. Insurance, he's already cleared in principle. The only problem with these two reforms is they cannot be done by executive decision alone like the FDI. They need parliamentary approval. This is not going to be easy if you take into account what happened in the last two sessions of parliament. Provided that these steps are taken and parliament approves, do you think that at least that will restore confidence? Is the second wave of reform and the clamour for it driving the current discourse right now, specifically the discourse from the rating agencies?
I personally think if parliament meets and parliament sits, then this will pass, because the BJP is committed its support to it.
So they're not exactly against it.
They're not against it, and they had it in their government in 1999, and then they had to taper it down because the RSS made a noise and things like that. So it came to 26. There's no difference between 26 and 49. And I think that, we should really be thinking beyond 49. Because you want to get those pension funds from abroad to be invested by their companies here in our infrastructure, in our industries, then they should have control of their operating companies in India.
Right.
You can't expect them to have some Indian control over it and then expect them to lend the money and trust the money to people. It's just not feasible. So we should be gearing at, there's $79 trillion in insurance funds in the world. To get a fraction of that, take care of our infrastructure problems. No, you'll be thinking big. And I think there's a job for the Prime Minister and the Finance Minister to preach to people, saying that this is why this is needed.
Right.
This does not mean that, that you're going to have LIC being sold to these guys. And LIC will be there. And GIC will be there, and all those guys will be there. But this is to facilitate investment in India.
Right, right.
And I think that job should be done by the Finance Minister and the Prime Minister, because they're politicians.
Exactly.
Planning Commission doesn't
And perhaps
come to
the
this.
NIB will come into play if it's the decision has to be taken. Very quickly, Jagannadham, insurance and pension sector, like he said, most probably if Parliament meets and sits, this will get passed. Do you think, how positive do you think that's going to be for at least these reports that we are supposed to be junking?
By clearing in cabinet, I think government has sent very strong signal that they mean business. At least they have cleared at that level. I think the sending a message to S&P, actually, we have done our bit. And secondly, on top of that, already the rupee has strengthened from 55 to 52, helping the oil subsidy, oil import bill. So already the purpose that is supposed to achieve, that was achieved. Even in December, if in the winter session, if it doesn't get cleared, for 3 months already we have taken the advantage of 52 rupees per dollar. So I think the half job is already done. I think if the Parliament functions, yes. If not, it will not get cleared, but the world doesn't end there.
Right. One quick last word from Rajesh Mahapatra. We are completely out of time, Rajesh. Your last take on this ratings, the ratings game also. Is North Block doing enough to get growth back on track? Like you said, domestic growth is the key, but reform, second wave of reform, should we expect that?
We haven't seen it. I think the measures that we hope should come, or we expect that should come, to recreate the resilience that I spoke about, which will be key to getting India back its place on the global high table. We don't see that coming. We don't see that to have happened so far. So that's the thing now one would need to talk about. Just to reiterate, S&P, Fitch, Moody's, they have a job to do. Let them do their job. We have a job to do, which is very different. And the finance ministry, policymakers, leaders in this country should be focusing on that.
Absolutely.
How to make growth inclusive and how to revive domestic consumption, domestic investment. And
Absolutely.
domestic
Rajesh, I think you've hit the nail bang on the head. I must thank all my guests before I sign off. Dr. Santosh Mehrotra, thank you so much for joining us. Rajesh Mahapatra, Mohan, Guruswami, as well as Jagannadham, Thunuguntla, of course, Moody's, Fitch, S&P, whatever you have, they have a job to do, like Rajesh said. But of course, the finance ministry shouldn't be really concerned about it. We shouldn't be concerned about what some rating agencies think about our growth prospects. Domestic growth, domestic drivers, like my guest mentioned, are the key. And like Mohan Guruswami mentioned, of course, we should try and tap into the $79 trillion pension fund that is globally. Even if you get a fraction of that, we will be in a much better position. That's all the time we have on The Big Picture tonight. Athar Khan saying goodbye, good night, and thank you for watching.